So you're looking at adding to your income streams, and for some reason, you've added up on a dividend investing video. Dividend investing is actually not as difficult as it sounds, and with some very basic rules, you can set yourself up on the investing path to enhance your riches that could last a literal lifetime. But with that said, nothing in investing is guaranteed, regardless what investors here on YouTube will tell you. There are some very dangerous and key factors you need to be mindful of when you are indeed looking at your dividend paying stocks. So today we're going to talk about dividend investing and how you can maximize your returns when it comes to making dividend investments in the UK. I generate over 4,000 US dollars every single quarter from dividends alone. And because of my simple strategy, this figure is actually growing at a steady pace year on year. In this video, we're going to go through the full process of dividend investing, what you should look for and what you should completely avoid. But before we start talking on how you can maximize your dividend income, let's first establish what a dividend actually is, because there's a lot of misinformation here on YouTube. A dividend is similar to the like button. As soon as you smash it, we all get much richer, and that is absolutely cheesy, and it sounded better when I written it down. But a business or a corporation pays dividends to its shareholders in order to distribute a portion of the profits that they've generated. They're usually paid on a regular basis and go in lines with set terms that are usually predetermined by a previous quarter's report. But it's worth noting here, not every single company actually pays you a dividend. In fact, majority of them do not. Apple only recently started adding a dividend, even if it is as pitiful as it is. So if you are only interested in dividend investing, be sure to pick dividend investing stocks. But how these dividends work is actually really simple once you get your head around it. So feel free to go back in the video to understand my next point. A dividend is usually paid on what's called a per share method. As an example, company A is going to pay you $2 per share on a dividend every single quarter. Now, if you own 30 shares, that means you're going to get 30 times $2 equaling $60 back in a form of a dividend. That, in essence, is how they work. A lot of people get confused here and they go and look on Yahoo Finance, where you can find this information, by the way, for free. And it's also worth noting that this percentage figure you usually see on Yahoo Finance is over a 12-month period. So if you are new to investing, it's worth really trying to get into the whole dividends per share method rather than the percentage method, because share prices do indeed move. Well, as I mentioned earlier, a dividend is a way of distributing profits to reward loyal shareholders. It serves sort of as a token of appreciation for the continued support, as well as motivation for shareholders to continue investing into their own specific company. And having this safety stream of dividends does attract more and more investors over time, meaning the demand for your stock goes up, meaning the value of your business also will go up. But it is worth reminding here, because with a lot of dividend investing videos, a lot of people forget if you buy a stock, a share, you are now a physical owner of that business. You are actually entitled to a cut of the profits and indeed a vote, in most cases, on how the company should run. Dividends are great for individual retirees, charities, investors, and even professional portfolio managers. It's basically good for any investor who is looking at getting a steady source of extra income, which, let's be honest, is pretty much everybody on planet Earth. And these people want to increase their wealth, whether it's for them individually or in turn their clients. But dividends, unfortunately, are not that easy. It's not that consistent. A year ago, the UK was engulfed in unrest and characterized by COVID, lockdowns, market exodus, deflationary worries, and unprecedented dividend cull. A large number of corporations and companies reduced, postponed, or even cancelled their income payouts. In fact, the Bank of England ordered banks to cancel all their dividends last March alone, a move that would be simply unfathomable if you go prior to the 2008 crash. In the meantime, oil company Royal Dutch Shell dealt the UK's cult of equities income a mortal blow by reducing its dividend for the first time since the Second World War. While the uncertainty still reigns high today, the microeconomical landscape has very much changed. In fact, some would say it's completely reversed and the world is back functioning sort of as it used to. Investors are now returning to the market looking for the summer of super dividends seems to be back, and investors are scrambling for dividend income once again. So it seems that things are looking up for those who are looking for dividend income. But in such an environment, how can you actually run a profit from dividend income when people have much more experience than you? Well, the first thing you actually need to do is look for a company that's making money and giving out dividends that are strong and consistent. In other words, find a company that actually has the ability to continue paying you a dividend in the long term. It's not actually about how much return you get in percentage. It's more about the consistency the company can continue to pay you. Start by focusing on the dividend cover rather than the top line figure. Many people in dividend investing get seduced right away by seeing massive returns, thinking they will get 1% every single month in cash back into their account, and that might work in the very short term. But ask yourself this: will this company you probably have never heard of before be able to long-term sustain paying you 1%? And what's more, will their stock price continue to do so too? Because if they don't have the cash to pay you, their stock price is going to go down also, meaning the dividend is actually irrelevant. So for example, let's say the company is going to pay you 10% a year in dividends, but every single year the share price is going to fall by 20%, meaning you've lost money. Your portfolio will not be happy if you buy a company just because of its high paying dividend, because it will soon make its way to the very bottom of your portfolio and end up being a huge loss. It happens all the time. Additionally, you can start separating the leaders of dividends to the doomed ones, and this can be done by looking at balance sheets, especially the free cash flow, also known as FCF. Now, the free cash flow is basically what a company has left over on its balance sheet after it's paid its staff, its bonuses, its rent, its taxes, all its other expenses. This cash is left over, and it can do many things with it. It can buy back shares, which rewards an investor long term. It can pay off its debt, which is also good for you as a shareholder. It could innovate and get a new product up and running, or acquisition another company, again, usually good for you as an investor. Or the one we're interested in, it can actually pay you a dividend. So free cash flow is very important to me as an investor, because that's the one that they actually use to reward me for buying into their business. Now, what I like to do, and what I suggest you do at least, is get their 12 months free cash flow. Find that figure, write it down, and see how much in the last 12 months they've paid as a dividend. Now, a lot of people might look at this and think, okay, if a company's got $1 billion in free cash flow and they're paying $1 billion in dividends, that's good, let's give it a big tick in the box. And actually, it's not the case. You want to make sure you have much more free cash flow than they are paying out in dividends. That way, if inflation hits, or there's a lockdown, or there's a big problem with the business, they still have enough money left over. Isolate that problem while still continuing to pay you a dividend. If they do not have this, and it's very close, these two figures, then you're asking for a problem later down the line. In fact, you will find a lot of companies paying high dividends that just do not have enough free cash flow. In fact, they're going to dilute you or take out loans to pay this dividend to you, which of course is not good in the long term. But there is a much simpler way for you to make money from dividends. There is a very easy, tried out method with something called Dividend Heroes and Dividend Aristocrats. If a corporation or a company has a solid track record of paying its shareholders a solid, stable dividend over the long term, it becomes what's known as an aristocrat. And this will for sure tell you something about the company's setup. You see, while some dividend payers are unpredictable, there's a small dedicated group that has made it their mission to not only distribute dividends on a consistent basis, but also to increase how much they pay over time. If a company is in the UK and it wants the title of Dividend Aristocrat, it must increase its dividend payment for a minimum of 10 consecutive years. A US-based business must have a 25-year limit, and it's not unprecedented that in these interest rate depressed times, companies in this category have attracted a hell of a lot of attention in these unprecedented times. Companies like Diageo, the owner of Guinness, and Unilever, the manufacturer of Dove soap, and other household names, have an extensive brand of portfolios and a global presence. Due to their market dominance, these companies typically have a much more steady and stable source of income, meaning they can continue paying you a dividend. And what's more, there's an even easier way than that than just going buying some dividend aristocrats that you've heard of. A way that will save you hours upon hours of looking at free cash flow statements and pondering which aristocrat to pick. These major players can all be purchased at once through a Dividend Aristocrat ETF. An ETF, if you don't know, stands for Exchange Traded Fund, which is basically a group of companies together that somebody is actively managing for you. These funds will automatically help you with the performance of dividend stocks and do all the legwork for you, meaning it's the lazy way of dividend investing. Examples like the SPDR S&P US Dividend Aristocrats ETF. This ETF is following the 60 highest yielding US dividend stocks, which have also had 25 years of growing their own dividends. In the UK, we have the SPDR S&P UK Dividend Aristocrat ETF. Again, another big mouthful to say, but this is the UK version of that, only going after UK Dividend Aristocrats. So if you're looking for the most passive way to investing dividends, I strongly suggest just looking at an ETF. It's going to save you a lot of heartache break and just continue buying in on a regular basis. But now let's darken the mood and look at the bad side of dividend investing, because there's for sure some risks that are never addressed in any of these videos. Coming to the point that holds true of any investing portfolio, and a lot of people even in ETFs miss this point, and that is to diversify your income. Think about it. If you'd have just invested into banks that pay usually solid dividends in the last 12 months during the whole lockdown situation, when banks were ordered to stop dividends, you wouldn't have had any income whatsoever, let alone watching these stocks fall in value. If you diversify your income across industries, the countries in which your companies operate, and the sizes of your companies, you can lessen the influence that any one occurrence has of the overall dividend income you receive. Investing into funds and ETFs is a great way to kickstart your diversification, but that said, don't just hold one ETF tracking dividends in the US. At least even then, go and diversify into set sectors and maybe add one or two aristocrats you like yourself. If you want, say, more exposure to oil, go and buy a dividend aristocrat in the oil area, like Shell or BP, or if you're in the US, maybe Exxon. Make it your mantra to diversify and put your money into multiple stocks and ETFs, but just obviously make sure that don't diversify for the sake of diversifying. Make sure the company or the ETF was actually worth investing into in the first place, because a lot of people just buy 10 bad companies and say, well, it's diversification. No, they're all 10 bad companies. Also avoid dividend clumping, which is basically why you force yourself to diversify, where you might go and buy several companies in the same sector. Like I said, Shell, BP, and Exxon might all be great paying dividends with good cash flows and tick every single box we've talked about earlier, but if oil goes to negative like it did previously, these companies just won't be able to afford to continue to pay you a dividend. The last thing you need to understand from dividend investing is actually dividends need to be declared and taxed. There is a few ways to get around this, so let's quickly go through that now. Most countries have a dividend exemption amount. You need to go away and find out what that is, and anything under that you don't need to declare and you don't need to be taxed on, but anything above that, of course, you need to pay taxes. The tax-free period beginning April 6, 2021 and April 5th, 2022 was 2,000 Great British Pounds. But dividends received through tax-efficient accounts actually don't need to be taxed at all. The UK government has increased tax on dividend income by 1.5% beginning April 22. They did say, however, it's in order to fund the National Health Service and other social care programs. Basically, before the tax rate was 7.5% on dividends, and now it's 8.75%. And I'd say you can expect similar increases on taxes on dividends to continue in the future. So if you're looking to invest in dividends from the UK, here's my advice. And again, it's not really advice. Here's my opinion. You should go and look at an ISA account. An ISA account, to my knowledge, is not actually taxed on dividends. You can actually let your dividends grow tax efficiently while you have this ISA open. So that's what you should go and look into. And if you're from the Europe or anywhere else, you should go and also look at the equivalent in your home nation. Now, it is worth noting with dividends, not everybody is a fan of them. I myself don't actually concentrate too much on dividend investing. I'd rather see a company reinvest that money to help grow the business long term, because I think they can get a better return on it. However, I do like receiving dividends too, and I do hold some stocks that do pay me a dividend. For me, if you're a new investor, buying a dividend ETF is the best way to sort of kickstart your journey and sort of encourage you to continue investing. When you get a little notification on your application that you've just been paid money for doing nothing while you sleep, it's honestly a great feeling, and I strongly suggest everybody try it, because it's definitely going to get you at least interested in the investing world. Another step I would say do to help increase your wealth over the long term is seriously start looking at budgeting. It's a really overlooked part of the process, and I myself used one simple hack up here that literally changed my finances forever, and it really can help you too. Thanks very much for watching, and if you can help me out by dropping what city you're watching from down in the comments, it would greatly help me out with the YouTube algorithm. Best of luck out there, and I'll see you in the next one.